Colleagues, it's Tusana and PM Sebata. I'm doing an evaluation on this company, DVA Davita. It's in the medical care facilities. Yeah, I looked at the stock and I thought I'm interested in having a go at this one on the short side. But yeah, I'll take you through my investment thesis and my thinking behind it, but it will be very brief. I'll try and keep it short. So this is the chart. On a weekly basis, it looks like this. Yeah. Since July last year, we're in 2021. Since July 2019, that's where it hit the low at 42. It has gone all the way about 3 times to 117. 117. Nice run, but I think it might be time for it to take a breather and go on the short side. This summary on the fundamentals. I like using this website, FenVis, to do my high-level desktop type of fundamental analysis. It's definitely slightly out of my range. I like stocks which are 20 billion and above, but I made an exception for this one. PE is great, forward PE is great, but there might be a reason why it's this low. And what really caught my eye was the debt to equity. But this debt to equity, remember, it's debt to equity. The equity being viewed at book value, not market value. So it's 5 times the equity, which looks bad, especially if you are considering that this stock might be in a stage where one might need to start shorting it. Once stocks start going down and they have lots of debt, they can catch some pain. And also, the sales in the past 5 years haven't been grown. The average has been minus 2%, 2.3%. So it's not been growing revenue, has lots of debt. Yeah, but all other things look fine. Return on equity, great. Return on investment, great. Gross margin, 31%, cannot complain. Yeah, they make money, they make good money, only that their sales are not growing and they're carrying lots of debt. Inside transactions there, yeah, but I did not go into depth about that one. The analyst's mean target price is 102. They're already way above it at 117, but it's almost, you can also call this one at fair value if you consider these analyst targets prices to be anything to go with. But what I like is this company made some serious money for the investors up to now. But does continue making it, because I want to present my case that it's time to short this stock. So what I did is I did both fundamental and technical analysis. I'll take you through the fundamental where I did a proper, complete intrinsic valuation. Yes, my spreadsheet is busy. It's really, really busy. Lots of inputs and whatever. I'm not focusing on showing you how I do my intrinsic valuation today. I'll attach this spreadsheet on my YouTube. If one is really interested, they can then dig into it. But today I'm really going to be brief. When I did my evaluation, my estimate value per share came to 119. The price is 117. There's nothing into it. So based on my intrinsic valuation, this thing is at fair value. But I pulled some assumptions which most people might not be comfortable with. The growth for the next 5 years, I put it at 0. Remember, this company has been shrinking at 2.3% for the past 5 years. And I'm upgrading them now that in the coming 5 years, they will just break even. So some people might think that they have more growth to come. I didn't give them any. Other than that, I kept everything basic. So the valuation I got was that. But my focus really today, I want to go to this point which I was raising here, that their debt looks like a little bit too high. So in my evaluation, when I do my evaluation, I have an analysis, which is one of the tabs here, called optimum capital structure. What this basically looks at is what's the current, what's the optimal. Optimal is based on some calculations below here. But in essence, when I look at debt to debt, debt per debt and equity ratio, based on market value, The market value of equity is 13 billion. The market value of interest-bearing debt is 10.5. So when you put this ratio, you get 44.62% currently. And when I look at the optimal basically what it does is this. It has a spread of these debt to debt equity numbers up to 90. Then you look at the output here, which one is giving you the highest value. This time you are getting the highest value at 27, sorry. So this will be the optimum debt to debt and equity ratio. You can call it debt to capital ratio. The optimal will be there, but they are currently sitting at about 40 something, which is 44 something, which is about way below the optimal, almost at half the value. The value of the company would be doubled if they were at optimum capital. So we have a capital balancing issue with this company. Optimum is about a 10. They are currently at 44. There need to be a change or readjustments up to 34. That's why I was saying this company, if it faces the potential for investors panicking in a down market, it will be hard hit. This is what I was referring to. As I said, this spreadsheet will be attached at the bottom there. And then I did some ratio analysis. My return on invested capital with my adjustment was about 12%. And on FinViz, it's about 13% for return on investment. So really not much difference there. But the difference kicks in here on return on equity. But my return on equity, I use the previous year's investment compared to the current year's returns. So it's slightly different, but yeah, that one is not really significant. For me, the key thing is this debt to equity ratio, where they are going at about 4 times what debt they should be having. That said, that was my analysis. And why am I interested in that debt situation? Because I want to short. For me, the issue that they have lots of debt can help me as a catalyst on the way down. Also that they have not been growing their revenue can be another catalyst. And this company has serious beta, 1.3, so it moves way more than the market. Yeah. Other than that, the company has performed well going up there. Let me look at my analysis, my weekly analysis. What I see is, let me just draw the lines. Currently, RSI is heading downwards, it's not making new highs, while price is making new highs. That's a clear case of divergence. From that point to there, price is making new highs. RSI has refused to confirm it. This is a sell divergence. Also, on this stock RSIs of mine in this frame, they are all grouped at the top there. You can see them there, they are grouped at the top, which tells me this is a topping zone. So I have divergence and groupings signifying a topping zone. Also, stochastic is way overbought at 93. If you see this red part there, follow it when I'm at the candlestick for the week. It's at 98. So stochastic is way overbought. So I have all my signals syncing up, except for the flip on parabolic SAR, and my moving averages are still slightly pointing up, but this for me is a topping zone. Once I've got divergence and the grouping, I'm more comfortable with setting up an option structure to short this market. So technically, based on my weekly chart, this is a sell. Fundamentally, it has some challenges which can be good catalyst to go on to short it also. So my take for Davita is that I will be interested in shorting positions from this range. We'll see how the market responds. And maybe after 2 months, 3 months, we can revisit this one and see what happened to it. But my technical analysis saying this should be shorted. Fundamentally, I don't like the story I'm seeing. And that's what it is. This one is for shorting. I thank you. It's 2:09 p.m. Sabata. Bye bye.